I am Marie Brown, and this is my channel, Minds in Motion, where we discuss finances, investing, personal accountability, and how to find our purpose in life. Around the year of 2015, I began my journey of financial freedom. The reason why I want to reach financial freedom is so that I can not only become the best version of myself to help my family and also to help others. I enjoy working with others. I enjoy helping others reach their goals and accomplish the things that they want in life. So by me reaching financial freedom, I will no longer have to work as an obligation. I will be able to do what I feel like my purpose in life is, and that's to help others just become the best version of themselves. So today's video is about staying ahead of the market volatility and ETFs and how they play a role in this volatile market. I'm going to be discussing three particular ETFs, which are low volatility ETFs in comparison to Spire, the S&P 500 index ETF. The three ETFs that I want to discuss today are ticker symbol SPLV, the Invesco S&P 500 low volatility ETF, ticker symbol Fdlr, and that's the Fidelity low volatility factor ETF, and last but not least, ticker symbol USMV, which is the Ishares Edge Msci minimum volatility ETF. Just so you guys know, this is only for entertaining and for purposes of learning about these particular ETFs. I am not invested in any of these ETFs, nor is this investment advice. Also, if you guys haven't yet, I would ask that you would please consider subscribing to my channel. And also, if you like the content that you're seeing so far or throughout this video, if you find this content helpful, useful, or even entertaining, I would ask that you hit the like button. It really does help out the channel tremendously. So let's look at a video on Yahoo Finance in reference to the volatile markets and how ETFs play a role in these markets. I will leave a link in the description to this video so that you can watch the video in its entirety. However, we're only going to watch a small portion of the video in reference to the information that we're going over today.
It is now time for our ETF report, brought to you by Invesco QQQ. Today we are watching the ProShares VIX Midterm Futures ETF. Recent seesaws in the market are reigniting fears about how the $4 trillion ETF industry will react in a liquidity crunch. That's according to a new Bloomberg report. Now, some are pointing to a potential fix that, while it's still banned in the U.S., is regularly modeled overseas, allowing ETF providers to pay market makers directly. Joining us now from the CBOE trading floor is Cynthia Murphy. She is the managing editor at ETF.com. Cynthia, what do you think about this approach?
There is nothing bad about you incentivizing a market maker to keep markets tight and working well for ETFs. There's really nothing bad you could say. These people are in the market to make money. They're looking for profits. And if you can incentivize them to make sure they're there present, even during really hard times, it's a good deal. I know there's some regulatory issues with it, whether there be a conflict of interest from an issuer perspective to be paying somebody to go make markets for their ETFs. But, as an idea, it sounds like a pretty sound idea.
A lot of investors asking the question about how do I hedge against all of this volatility? What is the advice you're giving to your clients? Just to clarify, we are not financial advisors, but there's a couple of things that go on when the markets get this volatile. One is this conversation about, ETFs and a liquidity crunch. Should you get out before everybody else runs for the exits, because you're going to be stuck in a position that becomes illiquid if there's a run for assets. And if I'd like to debunk this myth a little bit, because a myth it is. ETFs work really well. They have great liquidity. Because they come from two sources, a primary and secondary liquidity. The
cliff note here is that the ETFs are a great price discovery mechanism, and they trade at pretty close to fair value to their underlying holdings. So the fear of a liquidity crunch in ETFs is really overblown, and we tend to see headlines like that when the market gets volatile. Now, as an ETF investor, if you want to protect yourself from volatility, I mean, there's many, many ways to do it. What's cool about the ETF wrapper is that there's so many solutions today that play around with not only asset class diversification, but different ways to approach volatility and protection within a single index. So for example, if you're an S&P 500 ETF investor, you can actually own an ETF today that gives you exposure to the S&P 500, but it has built-in mechanisms to protect you from downside moves, like dramatic moves. Some use VIX futures as a hedging mechanism within that portfolio. Other uses treasuries. So tickers like SWAN, SWAN is a great example of that type of ETF, or the Invesco PHDG is another great example of these ETFs that are built to give you that downside protection without you having to get out of the market.
All right, awesome, guys. So again, on ETF.com, and if you guys have never used this site or looked at this site, it's a great site to do research on ETFs or just find out what's going on with the many different ETFs out there. There's an article, and again, I will put the link in the description below, Staying Ahead of the Market Volatility. Now, in this article, it says that investors found low volatility ETFs to be particularly appealing. Between July 1st and August 26th, funds that invest in historically low-risk stocks gathered $5 billion of net inflow, even as equity ETFs as a category experienced net outflow. So again, the ETFs that we're going to be discussing today, let's start with the SPLV, the Invesco S&P Low Volatility ETF. It holds 20% of the stocks inside of the broader S&P 500 index that have incurred the lowest 12-month volatility. The premise behind this and other low volatility funds is that the stocks inside can withstand future market swings better than most, given that they have demonstrated, demonstrated this, in other market conditions. So let's look at the SPLV here. The current price of SPLV is $56.72. It has a net asset of $11.82 billion. It has a beta of 0.64, and that's compared to the S&P 500. It has an expense ratio of 0.25%, 25%, and it has been in inception since May 2005 of 2011. So I like to look at this chart, which shows the growth of a stock or ETF. And as you can see here, this particular ETF, since inception, it has done nothing but go up. It had a couple little dips here and there, but nothing to call home to mom about. I say that for the time that it's been in inception, which is about 8 years, it has done nothing but go up. So for those who have owned this ETF, they have seen some good appreciation. Now, the next ETF that we're going to look at before we get into each of these ETFs is the Fdlr, the Fidelity Low Volatility Factor ETF. Its current price is $36.60. It has a net asset of only $240 million. It does not show a beta for 3 years because it's only been in inception for 3 years, not even 3 years yet. We still have a couple of weeks, September 12th, before it's been in inception for 3 years. And it does have a little bit higher expense ratio than the last one, which was 25% at the 2.29%. So let's look at the 3 years that this ETF has been around. As you can see, it has grown over this 3-year period, but as you can see here in 2018, December, it took a big dip to $29, and it has been going up since then. The last time that it had a pretty low drop was in May, and it only dropped down about $3, which is not too bad for a fairly new ETF, in my opinion. Now, the next ETF that we're going to be comparing today and we're going to look at is going to be the Ishares Edge Msci Minimum Volatility US ETF, ticker symbol USMV. It has a net asset of $30.62 billion. It has a beta of 0.70. It has a lower expense ratio than both of the two that we just looked at 0.15%. It has been around almost the same amount of time as the SPLV. It's been around since October 18, 2011. And let's look at its graph. And as you can see, it has had really good growth also. It has done nothing but go up as well. So if you have owned this ETF, you have also seen some good appreciation from the time that you owned it. I mean, it did have a slight dip around the same amount of time as the Fdlr in the December of 2018 time, but it looks like everybody pretty much took a dip during that time. So the next thing that I want to do is I want to go back to this article on ETF.com, and I want to look at each one of these low volatility ETFs. So the SPLV is rebalanced and reconstituted quarterly with the latest shift during the third week of August. So the SPLV just recently had a rebalancing in its stocks. The weighted SPLV headed into August with relatively high and low exposure to certain sectors and remained similarly positioned, but we found some interesting changes. So these are going to be the changes that SPLV made during the third week of August. For example, utilities is now 28% of its assets, up from 25% previously, and much higher than the 3.5% in the Fdlr, which is the Spire ETF. The elevated weighting was aided by the addition of ticker symbol NI and ticker symbol SRE in August. So those were some of the major changes. Also, in the healthcare sector, one of the least volatile sectors according to the CFRA, SPLV continued to have relatively low exposure to the sector compared to SPY. With the removal of Pfizer, the sector was now just 2.8% of the ETF contrast, and it's now representing 14% of the SPY index, ETF. Now, though SPLV sector weighting to financials is 22%, it remained above SPY at only 13%. There were stocks replaced in August. So BBT, also CBOE, and then JPM joined while they took out PBCT, which I am long on in my cash flow challenge portfolio, which I'll be doing an update probably on Tuesday this week since the markets are closed on Monday. And then also the SPGI and WLTW were removed from the SPLV. So that is just the changes that SPLV made in the third week of August. Now, the next one that we want to look at, the other low volatility ETF sector with the Fidelity Low Volatility Factor, ticker symbol FDLO. They also underwent a rebalancing in August. And what they changed were some of the largest sector exposures to the information technology, 22% of its assets. In August, JKHY and Microsoft were added to the FDLO, while CDK was removed. In addition, Facebook joined the portfolio, and also while Marathon Petroleum from the energy sector was removed as well. So I want to look at this little graph here really quick, as you can see, guys, right here. So it shows you each one of these low volatility ETF in comparison to SPY. As you can see, SPLV is the highest in financial, while SPY and FDLO are pretty much the exact same. And then you have USMV, who has not underwent any type of rebalancing. They will not be rebalancing their ETF until November. Then you also look at the healthcare sector. Again, FDLO and SPY are pretty much the same, with FDLO at 13% and SPY at 14%. However, SPLV is only at 2.80% in the healthcare sector and USMV 11%. Then if we look at info technology, you'll see that FDLO and SPY again are pretty much the same. SPLV only 5.7%, 70%, and then you have the USMV at 16%. And then last but not least, utilities. Again, you'll see here that the FDLO and SPY are the same, with utility sector at 3.50%. However, SPLV, as stated in the article, increased their utility weighting to 28% from 25%. And then you have the USMV at only 8.50%. So that's pretty much the changes that these particular low volatility ETFs have made. Even though the USMV has not done any rebalancing yet, as I said before, it will not happen until November. Their largest sector exposure is information technology at 16%, financials at 14%, and then consumer staples at 12%, with utilities only at 8.5%, as we saw in the little chart that they put here. And again, I will link this in the description so that you can go back and look at this whole article. And again, if you guys like what you're seeing so far, I would ask that you would just please give this video a thumbs up. Also, consider subscribing and leave comments if you guys own any of these ETFs or what your thoughts are about ETFs in the volatile market. So let's look real quick. We've already looked at each of a quick analysis of these ETFs, but let's look at the holdings here for each of these ETFs. So as they said before, for Invesco's, you can see that a lot of their main holdings come from the financials. They have a lot in real estate. They also have a high holdings in utilities. And then the next highest sector would be consumer, defense, or industrials. Let's look at the FDLO sectors. They have most of their holdings in the financial service area, technology, industrials, and in the healthcare sector. And then for USMV, their holdings is almost, they have, I would say, more spread out in their holdings. They have technologies, industrials, and they also have the healthcare sector, consumer defense, real estate, and financial services being the highest sector weighting in this particular ETF. So last but not least, let's take a look at SPY and its holdings. SPY has most of its holdings in the technology area. And then you'll see that the next is financial services, healthcare, and then the consumer cynicals. So what I did here was I created a little chart here to compare each of these ETFs. Let me just move this out of the way. So as you can see, the SPLV and USMV are most similar in holdings. However, as you can see, the weightings of these companies are very different in each one of these ETFs. So even though if you look here, they both have Republic Service, however, one is 0.25%, and then this one is 0.43%. So this one is more heavily weighted in Republican services. Then you see NextEra Energy is at 1.19%. However, they have 1.31%. And Coca-Cola, they have 1.15%. And this particular one has 1.52%. And then Waste Management is at 1.14% for the SPLV. However, Waste Management is 1.55%. Then if you look at Fdlr and Spire, you'll see that a lot of the holdings that are in Spire, Fdlr has, which we already knew from the earlier comparison. It's pretty much almost similar. The only difference is you're going to see here the percentages. So Apple is a little less in Spire. Then Spire holds two different Googles or Alphabet. However, if you add the percentage of both of them, you'll see it's about the same percent. And then Berkshire Hathaway, they both hold that. And Fdlr has a little higher weighting of that stock. And then Johnson & Johnson, again, Fdlr has a little higher weighting than the SPY. So if you do a comparison of these, it's pretty much depending on what type of sectors you like. Even when you're invested in the ETF, you still want to do a little bit of research about the holdings and what those companies are doing and how those companies are doing in the market at that time. You also want to look at the expense ratios. You also want to look at the inception dates. How long have they been around? And then you also want to look at their yield, the yield and the year to date. So those are just some things that you want to consider when you're looking at an ETF. Again, please like the video if you enjoyed this content. Please subscribe to the channel if you enjoyed this content, and also leave a comment about what you think about these ETFs, if you currently own any of these ETFs or if you plan on owning any of these ETFs. Last but not least, I do want to go over something really quick in regards to ETFs that I also agree with. So the CFRA thinks understanding the sector exposure of smart beta and ETFs is important, but investors should also understand that stocks drive future performance. Even when there's overlap in the names inside two funds, the weightings might be different. For example, Facebook represented 1% of the USMV asset, far less than the 1.7% in the Fdlr. So if the elevated market volatility encourages you to seek safer alternatives in the equity space, remember that while these ETFs are index-based, they do make portfolio changes. So as you can see, even though ETFs hold certain stocks at certain weightings, they do rebalance their ETFs. They do look at market conditions, and the weighting in an ETF does play a factor in the performance of an ETF, even though two ETFs may hold some of the same stocks. So again, thank you guys for tuning in. And one last thing before I end this video, I do want to shout out Rico Suave Investing. His channel has been growing the past few weeks. However, even though he is a small channel trying to get his channel up and running, trying to get monetized, he has been so good at also showing love to us other small YouTube channels that are also trying to get our channel up and running, trying to be seen on YouTube. He is showing so much love. So if you guys are not following him, if you guys have not went to his channel and checked out his awesome content, his awesome personality, please take the time to do so. Leave him a message. Let him know what you like about his channel. Please give him a sub if you haven't. And other than that, you guys have an awesome and an amazing day. Thank you for watching.